It's official, guys. It looks like Fed Chair Jerome Powell is dead set on wiping us out. They just grilled him in Congress about it. Here he is with Senator Elizabeth Warren explaining how his Fed rate hikes are going to lead to 2 million Americans losing their jobs. Check this out.
In December, the Fed released its projections on the state of the economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
So what would you guys tell Jerome Powell if he were right in front of you right now? Just drop me a quick comment down below. Now, at the beginning of this meeting, Jerome Powell suggested that the interest rates, they could go higher. They could get there really fast, and they could stay there longer than they initially expected. But let me repeat this, guys. Interest rates could go higher, get there fast, and stay there longer than they initially expected. That means higher interest payments on your credit cards, your car, your mortgage. Businesses won't want to expand. Jobs will be lost. I mean, so much for that transitory inflation, right? Now, I'm definitely expecting the transitory recession that follows. So yeah, let's talk about how the interest rates are so important to the economy. So the stock market, the housing market, all financial markets right now, every one of these will be impacted. We're also going to answer one of your money questions and your cash flow questions, and when to downgrade a card versus when to cancel. All in today's video. Definitely stay right there. But before I continue, please take a second, drop a like for the video. Totally appreciate that. And for your daily dose of the truth when it comes to the stock market, the housing market, Social Security, SSI, SSDI, and everything that's going on in Washington, D.C. that affects our lives, our families, and our bank accounts, go ahead and subscribe to the channel. And if you own a home, make sure your home is protected. Get your free home warranty quote. There's a link in the description down below this video. It only takes like 15 seconds. Now, you guys know me. I'm a realist. I think mainstream media and other YouTube channels are so quick to either paint rainbows and kittens or fear and doom. And this is why I always keep our financial freedom fam in mind and do my best to keep our channel fact-based and realistic. As much as possible, it's all about the here are the reasons and think for yourself type of videos. Now, with that said, here's a summary of Jerome Powell and what he's talking about regarding interest rate hikes and how likely they are to go higher, faster, longer, and all of that.
He talks about the recent data where he says the January data partly reversed the softening trends they'd seen late last year. This likely reflects, he said, unseasonably warm weather, but he suggests that even if you take out the warm weather, it still suggests inflation is running higher than expected. On inflation, Powell says the process of reducing it has a long way to go and is likely to be bumpy. More on inflation, he says it's moderated somewhat, but still well above target. He expects housing inflation to decline in the year ahead, but there's little sign of disinflation in the area that he continues to point out, which is core services ex housing. On the economy, Powell says there will likely be a softening in the labor market this year. While wage gains have slowed, Powell says they have remained above levels consistent with the Fed's 2% inflation target. The U.S. economy slowed significantly last year, and as for consumer spending, it is rising this quarter at what he calls a solid pace. There's been some recent indicators that point to subdued growth in spending and production, but overall, he says the labor market remains extremely tight. So there it is, guys, the possibility of a higher rate, the possibility of getting there faster, and the idea of staying there for a long time.
Powell's exact words, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. Now, if the totality of the data were to indicate that faster tightening was warranted, we would be prepared to increase the pace of interest rate hikes, end quote. Now, like you heard, Jerome Powell already laying the groundwork for more interest rate hikes in the very near future. But what's worse, this whole thing's probably going to happen a whole lot faster and a lot longer than previously anticipated. Before, officials were pegging the Fed rate to top out at somewhere around 5.1%. But now, investors and Wall Street analysts, they're saying it's probably going to land somewhere between the range of 5.5 and 5.75%. And that's pretty big news, guys. More on the effects and the predictions of what's going to happen later. Now, Jerome Powell said this, quote, "We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do," end quote. Plus, he said that the road there could be bumpy. Now, all I want to say is bumpy for whom exactly? Is it going to affect Jerome Powell and his family? Is it going to affect billionaire tech entrepreneurs like Elon Musk and Jeff Bezos? I highly doubt it. But what about you guys? Now, I said last year, I couldn't see the Fed pivot being fully executed until early 2024. And I'm even more convinced that this will be the case now. So what does this all mean for you and your cash flow? Well, as always, it wouldn't hurt to add onto your income streams already. Those with credit card debt should definitely brace for more interest rate shock in the coming months, since most credit cards have a variable interest rate that goes up with those Fed rate hikes. But even now, the average credit card rates, they're at an all-time high of 19.93%. Now, by comparison, the average credit card interest rate stood at around 16.3% at the outset of 2022. Now, if you're carrying that credit card balance from month to month, which most people are, it may be a good idea to consider transferring your balance to a lower interest option, such as a 0% interest balance transfer credit card. Mortgage rates are also staying hot. Now, while mortgage rates don't follow the Fed funds rate exactly, they are definitely impacted by the downstream of the central bank's policy. Each time the Fed raises the benchmark rate, variable home loans, they tend to move in tandem. That means that pretty much anybody shopping for a new home in early 2023, they should expect a smaller house and probably bigger house payments. Not a good combination. Now, those looking to finance a car should also plan to shell out way more money. The Fed's rate hikes will increase interest costs for new auto loans. Last I checked, auto loan rates were around 6.18% for a 5-year new car loan. This is up from 3.96% at the beginning of 2022. But hey, if you got some extra money in the bank, make sure you're making the most of your interest rates on your money too. I recently did a video on online banks and certificates of deposits offering rates higher than 5%. That even beats out the stock market in some years. And I'm a huge fan of diversification. Definitely investing in gold and other precious metals. That's a great way to diversify your assets. Hit the link in the description down below for the best way to invest in gold today. Now, we're going to need as much financial preparation as possible. Pretty soon, those Fed rate hikes, they're going to impact the job market, and that's probably going to mean layoffs, and probably even bankruptcy for a lot of Americans. Companies that were considering expanding their workforce and hiring more people, they're going to do a double take in this economy. New opportunities made possible by low interest rates, they're no longer on the table. And so this has implications for more than just businesses. Individuals seeing new opportunities vanish, they might start to feel insecure about their positions. Instead of job hopping to a new company, they might just decide to stay put. Democratic Senator Elizabeth Warren asked Jerome Powell to address the 2 million people who the Fed predicts would lose their jobs if the unemployment rates increase to the Fed's projected 4.6% by the end of the year. You know what she said in the clip? Quote, "What would you say to them? How would you explain your view that they need to lose their jobs?" End quote. So Jerome Powell, he answered back by saying, quote, "Will working people be better off if we just walk away from our jobs and inflation remains 5 to 6%? We are taking the only measures we have to bring inflation down." End quote. Wow. Jerome Powell admitted that the only tool that they have is to mess around with the Fed interest rates. But it didn't end there. Elizabeth Warren warned that the Fed has a terrible track record of containing modest increases in unemployment rates. Once the economy starts shedding jobs, she says it's kind of like a runaway train. We definitely do not want to hear that when it comes to working class Americans losing their jobs. I mean, am I right, guys? Elizabeth Warren concluded her line of questioning by telling Jerome Powell that he is gambling with people's lives. She said that we need a Fed that will fight for families. Finally, somebody making some sense here. I mean, no matter how many times Jerome Powell and these other lawmakers, they tried to push their own truths down our throats, it never made sense sense to me that for inflation to go down, honest, hardworking Americans have to lose their jobs. Why not increase supply? That does go in tandem with demand, right? All the while, billionaires lived it up in their rockets and their ivory towers. You know what I'm talking about? Something definitely has to change here. So right now, job openings are still at a near record high, but they have since cooled since the Fed started tightening borrowing expenses. The unemployment rate is still at a near half-century low. But the question is, how much longer could that last? Big tech firms, Meta and Twitter, they've laid off thousands of workers. Others, such as Apple, they've said that they're freezing their hiring. Economists see the unemployment rate climbing more than a full percentage point by December 2023, hitting 4.6% from its current half-century low of 3.5%. Sometimes a booming labor market can also contribute to inflation. When there's a mismatch between labor demand and supply, companies often boost wages to recruit more workers. And the real problem is that rising interest rates is what you could call a blunt instrument with no method of fine-tuning specific corners of the economy. It simply works by slowing demand overall. But the risk is that the U.S. central bank could do too much. Put in the mix that officials are trying to judge how rates impact the economy with backward-looking data, and you could definitely have a runaway train headed toward a recession cliff. Just to give you guys the facts, 8 of the Fed's past 9 tightening cycles have ended in a recession. There's a common mantra when it comes to the Fed: don't fight it. Most of the time, it means investors should just adjust their decisions based on how the Fed's tweaking their monetary policy. Right after Jerome Powell's remarks in the Senate Banking Committee hearing, U.S. stocks fell sharply as the news sent investors running for the exits, with all 3 major indexes, Dow Jones, NASDAQ, and S&P 500 dropping sharply. The market's expectations for a half-point rate hike spiked, shifting from a 30% probability to almost 70% by day's end. In corporate news, bank shares fell as investors worried that the higher interest rates would lead to a recession. JP Morgan Chase shares dropped by nearly 3%, Bank of America stock shed 3.2%, and Wells Fargo fell 4.7%. Pretty soon, it's probably going to look like a fire sale in the stock market. Something to consider if you're really looking for the next great buying opportunity. You could wait. Some are saying that you don't fight high inflation with 0.25% increases, that the economy needs a shock in order to return to a stabilized inflation rate. By shock, they mean a 1% increase in the prime rate this month, or otherwise, inflation will continue for years. Now, that's definitely going to turn some heads in the markets. A good way to prepare for more interest rates to come is to do an audit of your credit cards. It's actually simpler than it sounds. Basically, you just need to kind of answer when you should downgrade your card versus when to cancel it. But let me help you out with a little bit of guidelines. For cards with no annual fee, the answer may simply be nothing. Stick the card in the drawer and just forget about it. At best, you might find a use for it down the line. At worst, the credit card issuer will cancel it for non-use and you saved yourself a phone call. Just make sure to check it now and then for fraud or other anomalies. Now, what about those cards that aren't giving you your money's worth when it comes to those annual fees? And in this case, you got 2 options: cancel or downgrade. Downgrading a card is when you switch it out for another card in the same family that has a lower or no annual fee. There are definitely a few cases when it can be worth downgrading instead of canceling a credit card. The most common reason that people downgrade a card instead of canceling it is to hang on to the credit line. So when you downgrade a credit card, you're changing the product type, but it usually keeps the same credit card limit. That can also be good for your credit score. Now, if you don't want to downgrade, but you still want to keep your credit line, you may be able to transfer it to another card from the same issuer. Not all credit card issuers will let you do this, but it may be worth a phone call into customer service just to see if that's an option for you. Now, another reason to downgrade your unused credit cards is if the less expensive credit card product offers some of the same rewards or perks. This can let you still enjoy a rewards card, but without the high fee. So for example, let's just say you're paying $95 a year for a credit card that earns 4% cash back on groceries, but there's a card in the same family that earns 3% cash back and has no annual fee. You may not get enough out of the $95 card to make it worth the fee, but you may still want to earn grocery rewards. So in this case, downgrading to the no annual fee card could be a perfect solution. Now, of course, some cards simply don't have downgrade paths. Plus, downgrading a card generally means that you won't earn a sign-up bonus. So you might miss out on any kind of sign-up bonus that might be offered to the credit card that you're downgrading to. You'll have to decide if foregoing the bonus is is worth it if you decide to downgrade. But let me know if you guys want to learn more about maxing out these credit cards and any other ways to navigate these interest rates. Our comment section is wide open as always, you guys. But the big question is, what's going to happen next for interest rates and inflation? We'll definitely have to stick close to this one as the week goes on. Definitely do not miss out on future updates. But for now, this was your essential U.S. economy update and daily news report. The Fed is determined to wipe us out with those interest rates. 2 million jobs are on the line with a recession probably on the way. And of course, knowing when to downgrade or even cancel your credit card. Appreciate you guys always lighting up the like button. And don't forget to subscribe for your daily dose of the truth. Appreciate you guys watching. Please be kind to one another, and I'll see you on the next one.